Hello, this is Walter Barker again. What we're going to do is we're going to talk about how money actually works here. Give you an understanding of how money works. Um, First of all, this is how our financial system works in the United States. A lot of people don't understand this concept, but we're going to cover it here. First of all, on your money it says Federal Reserve note. Okay, that means it's a note paper. We used to have on our money, it used to say silver certificate. That means you could actually go to the bank and present it, and they will actually give you silver. Our money used to be actually backed up by gold, but now it says Federal Reserve note, legal tender for all debts, public and private. Now, this is how the bank system actually works. You go to the bank and you say, I need $100,000 to buy a home. Well, the bank doesn't have that kind of money, but it gets you to sign a piece of paper. And this piece of paper is signed $100,000 and you sign it in so many years and everything else. Then they lock it up because this paper is actually worth $100,000 by this particular time. And it goes into this little vault here. They lock it up in a file. You just ask, can I have my note paper back? And you haven't paid it off. You can't get it back. Well, see, that note is paper. So they say the Federal Reserve, hey, we got this person to sign this note here. Well, the Federal Reserve said, hey, I need a copy of that. So they make a copy, send it over there. And they said, listen, we're going to make 100,000 pieces of paper that says note on it. Okay, Federal Reserve note. Then they get the money, and then, of course, you build the house and everything else. So the only reason that this piece of paper is worth anything is because you signed a note, and this is worth something to them. This is worth actually more than than each of the individual pieces of paper here. So the money that you have in your wallet is actually carried by this debt plus interest. And this is kind of interesting to note that if everybody tried to pay back their debt at the same time, there wouldn't be enough money in the entire banking system to pay off the note plus the interest because they're not making enough money to cover the interest at any given time. That's why sometimes people run out of money. So the only way to stimulate the economy is to get people to sign more of these debt notes. And what happened recently is the subprime people said, hey, we really don't want to pay because that's too much interest anyway. And then all of a sudden it sent a shock wave through the whole system. Now, that's on the side of saying, hey, I want 100,000, they approve it, and and then you get an answer. Now, this is how to get them to approve the 100,000. This is how it works. You start out this way. Okay. You take $1,000 of money that you have and you deposit it into Bank One. Now, then you borrow the money on the CD, and you usually pay about 1% interest on the money. Now, then you deposit it into Bank Two, and you have and then borrow that $1,000. Usually they'll let you borrow your own money because they got no chance. Because if you default, they just cash in the CD that you got, and they got they break even. They got your $1,000. Okay, then you get the 1,000, you put it in bank number 3. You get a CD, and then you borrow on the money. Now you have your $1,000 back in your pocket from this, but you have 3 notes at about 1% each. You're making interest on all the money you deposited. It's a great credit builder. And here's what happens. Bank One, because of the banking rules, can then loan out $10,000 minus the $1,000 they loaned you. They can loan out to other people $9,000 more because they got deposited in their bank. Then bank number 2 can lend out $10,000. They got minus 11 that they paid you. That's $9,000. They could loan out more. And then bank 3, because you deposited in their bank, all of a sudden they minus the $1,000 they loaned you. They got $9,000 more. So now what's happening is they could loan $27,000 from the Federal Reserve out to more people because you deposited your $1,000 in each of the 3 banks, and they call you sir and ma'am. Your credit's built. You got CDs and everything else. Now, what you do is you keep paying the notes. You keep paying the notes, and it's almost like a savings account because what happens is when you pay off the notes, you'll have $3,000 in CDs in 3 different banks. You'll have great credit. They'll call you sir or ma'am, and they will loan you more money because you allowed them by your deposits to loan out more legally in the system. And that's how it works. Okay, so I hope you enjoyed that and understand that this is perfectly legal, and the only reason it stimulates the economy, it does something that the banks can't do themselves. It fulfills all the legal rules, and the Federal Reserve prints out more money, stimulates the economy, and you've got great credit, and this is building credit like crazy, and you'll enjoy that. So you can't lose except for the 1% interest you're actually paying on the money, but you're actually, depending on how much interest they pay on the CD versus how much money they loan you, they usually do 1 or 2% over the cost. But what you're doing is you're being called sir or ma'am, and you got $3,000 in $3,000 in 3 different banks, $1,000 in each bank, CDs. You're paying notes off. They can loan $27,000. They're happy. You're happy. They it just works out that way. And you know a little bit more about money. So if you have any comments on this particular thing, very few people know this. They haven't figured it out yet, but there's no problem with it because it's safe and stimulating, and you build credit, and you keep paying your notes, and everybody's happy. Okay, the government's happy, you're happy, everybody's happy. Okay, hope you enjoyed that. By the way, give me a email me at this address here, wbprotime@gmail.com for your comments and or suggestions. That's wbprotime@gmail.com. Thank you very much.